Did you know that the Australian dollar has lost more than 15% of its value against the US dollar over the past 2 years? That's right. And we're not talking about some random number. We're talking about your purchasing power, about how much your salary is worth on the global stage, and about your ability to build wealth. While the Reserve Bank of Australia raises interest rates to contain inflation, what should be a measure of internal strengthening might actually be weakening the average citizen's wallet. And maybe you haven't even noticed it yet, but you're paying more for everything, from your daily coffee to that long-awaited trip to Bali. What is really happening to the Australian dollar? And why isn't anyone explaining it to you in a clear way? Picture this scene. You walk into the supermarket, grab the same items you bought last week, but the total on the checkout screen jumps $5 higher. Is inflation to blame? Maybe. But what if I told you there's something deeper behind it? A hidden imbalance between domestic interest rates and the value of our dollar in the global arena. A power struggle that few understand, yet it directly impacts your life. While economists debate in complex articles, regular people feel it in their wallets. And if you keep waiting for an easy explanation, you might end up like many others, with a devalued superannuation fund, stagnant investments, and an unstable financial future. But in this video, I'm not going to give you more of the same. I won't repeat technical jargon that only confuses you or throw out statistics without context. I'm going to show you the truth no one tells you about the relationship between interest rates and the value of the Australian dollar. We're going to break down how these changes are impacting everything, from your ASX investments to your travel plans or your dream of buying property overseas. And more than that, I'll show you how to protect your money, even in a global climate full of uncertainty, in a way that's simple, practical, and tailored to Australian reality. So if you're tired of watching your money lose value without understanding why, this video is for you. If you want to know how big investors are positioning themselves and how you can do the same, even with a small amount of capital, stick around until the end. Let's begin with the question no one clearly answers. Why is the Australian dollar losing strength even though interest rates are rising? The answer will surprise you, and it might just completely change the way you manage your money from now on. Over the past 18 months, the Reserve Bank of Australia, RBA, has raised interest rates in a series of decisions. Officially, the goal was clear: to control inflation. But while newspapers splashed headlines about price control, something much deeper was unfolding. An invisible shift impacting currency exchange rates, investments, and even the job market. This is where the untold problem begins. Interest rates might be killing the Australian dollar from the inside, and along with it, your long-term financial plans. Let's start with a frightening number. In January 2023, 1 Australian dollar bought 0.72 US cents. By April 2025, that rate had fallen to 0.64. Doesn't sound like much? That difference represents thousands of dollars when it comes to imports, travel, and international investments. For a business owner importing parts from China, it could mean bankruptcy. For a student dreaming of postgraduate studies in London, it could mean putting their future on hold. For you, it could mean simply paying more for fuel, electronics, or even your kid's iPhone. And here's the kicker. This is happening while domestic interest rates are rising. Shouldn't the Australian dollar be strengthening? The answer is complex, and it's at the heart of this video. This is where we get into the concept of interest rate parity. When the RBA raises interest rates, economic theory suggests the dollar should attract more foreign investors chasing higher returns, strengthening the currency. But in practice, that theory breaks down when there's a lack of confidence in future economic growth. Investors look at Australia and see debt-ridden households, unaffordable mortgages, and declining consumption. Even with high rates, fear prevails, and money flows out of the country. The result? The dollar sinks. Take Emma, for example. She's 32 and lives in Bondi, a barista by day and freelance social media manager by night. Over the past 6 months, she noticed something strange. Her rent went up by $150 a week, her daily coffee rose by 50 cents, and the international transfers she receives in US dollars started converting into more Aussie dollars. At first, she thought it was great. More AUD hitting her account. But then came the Apple Store bill, the rise in petrol prices, and a sudden drop in international clients. "I can't compete with freelancers in Asia charging in weaker currencies," she told me. Emma doesn't understand monetary policy, but she feels the impact. She's on the front lines of a much bigger issue. The average Aussie is being squeezed between internal inflation and external currency devaluation. Meanwhile, the housing sector is walking a tightrope. On one side, high interest rates are scaring off buyers and cooling mortgage approvals. On the other, the falling dollar is pushing up construction costs, since much of the materials are imported. A study from the Australian Bureau of Statistics showed that the average cost of building a home rose by 11% between 2023 and 2024. And that's not even touching properties in cities like Sydney and Melbourne, which still sit above the $1 million mark, out of reach for many. The irony? The same RBA that claims to be making housing more accessible is helping to inflate the cost of living. And if you think this is just a local problem, think again. The global economy is more interconnected than ever. A slowdown in the US, a crisis. In China, a sanction on Russia. It all affects the value of the Australian dollar. Even those investing in the ASX aren't safe. Exporters like BHP and Fortescue might benefit from a weaker currency, but companies that rely on imported goods or external credit, like retailers and fintechs, get hit hard. The market is polarized, and the everyday investor often doesn't know what ground they're standing on. Now let's talk about superannuation. Many Australians have the bulk of their retirement savings tied up in funds exposed to global markets. When the Australian dollar drops, the value of those assets in AUD may go up. But it's an illusion. You're not actually wealthier. You just have more local dollars representing the same amount in USD. And when it comes time to retire, if you want to travel, buy imported goods, or maintain a lifestyle dependent on foreign markets, your super's real purchasing power may have collapsed. It's like filling a bucket full of holes. It may look full, but it's leaking the entire time. The problem is, no one talks about this clearly. Economists speak of currency decoupling, politicians point to the volatile global landscape, and banks keep pushing opaque investment products. Meanwhile, the average Australian is left wondering why they're working more, paying more, and living less. The hard truth? The Australian dollar is in danger, and so is your financial stability. But hold on, this isn't a panic video. This is a clarity video. Because now that you understand the size of the problem, you're ready to act. And that's exactly what we'll do in the next part. I'll show you concrete, accessible strategies to protect your wealth, invest wisely, and escape this currency trap with more control than you ever thought possible. Let's get something straight. You can't control global interest rates, inflation, or currency fluctuations. But what you can control is your response. And the truth is, the people who thrive during economic storms aren't the ones with the highest salaries. They're the ones who understand the rules of the financial game and play smarter. That's what this part of the video is about, showing you how Australians can build wealth even while the dollar falls, through strategies that are practical, accessible, and already being used by thousands of smart investors across the country. Let's start with the first solution, investing in ETFs on the ASX, with a currency-conscious mindset. Exchange-traded funds, ETFs, are bundles of investments that track indexes, sectors, or commodities. In Australia, the ASX offers dozens of ETFs that are low-cost, diversified, and incredibly effective at hedging against inflation and currency devaluation, if used correctly. Take, for example, the VAS ETF, which tracks the top 300 Australian companies. Historically, it's provided around 7 to 8% annual returns. Now imagine this. Even if the Australian dollar loses value internationally, investing in strong local companies keeps your capital linked to the internal economy, where you live, work, and spend. You're essentially anchoring your wealth in the same economic system that defines your day-to-day life. And that's powerful. But here's the twist. Don't just stop at local ETFs. Global diversification is key. Use platforms like ComSec or Self-Wealth to access international ETFs like IVV, which tracks the S&P 500, or VGS, which includes global developed markets. Why? Because when the AUD drops, these international investments actually gain value in AUD terms. Let's say you invested $1,000 AUD in IVV when the AUD USD was at 0.70. If the exchange rate drops to 0.63, the value of your investment, when converted back to AUD, increases, even if the US market stays flat. That's how currency hedging works for you instead of against you. Now let me introduce you to Liam, a 29-year-old junior architect from Brisbane. When interest rates began to rise and the AUD started slipping, Liam didn't panic. Instead, he moved 30% of his superannuation into an international equities fund, including exposure to US and European markets. He also started a side portfolio with ETFs like NDQ, which tracks the NASDAQ 100, and VEU, which includes emerging markets. I just figured if the Aussie dollar keeps sliding, I want to be holding something that rises when it does, he said. Today, Liam's portfolio has outperformed many of his friends' traditional super plans, not because he's a financial genius, but because he understood currency dynamics and acted early. And this brings us to superannuation strategy, one of the most underutilized wealth tools in Australia. Most Aussies treat their super like a black box. Money disappears from your paycheck and you hope it grows. But here's the thing. You can control your super, and when you do, the results can be game-changing. For starters, consider switching your allocation into funds with higher international exposure. Most default super funds in Australia are overly concentrated in local stocks and bonds, which means your retirement could be at risk if the AUD continues to weaken. Moving part of your super into international equities or currency-hedged options can significantly improve your future buying power. And don't underestimate the power of voluntary contributions. Even small amounts, like $50 or $100 a week, can compound over decades into six-figure differences. Use salary sacrifice options if your employer allows it, or make after-tax contributions with the intention to claim deductions. There's even the government's co-contribution scheme if you're a lower-income earner. The point is, your super can be a weapon, not just a savings pot. Here's a practical action step. Challenge number 1. Log into your super fund this week. Find out, what percentage is in Australian versus international assets? Is your super fund hedging against currency risks? What are the annual fees, and are there better performing options within your provider? Write this down, mate. Knowing where your retirement money is going is the first step to changing your financial future. But strategy alone isn't enough. You also need to adopt the right mindset. Building wealth when the dollar is falling requires calm, long-term thinking. Emotional investors panic sell or keep cash in savings accounts, earning less than inflation. Smart investors? They invest consistently through the ups and downs. They use dollar-cost averaging. They accept volatility as part of the game. So next time the news says, the dollar fell again today, don't freak out. Ask yourself instead, what investment becomes more valuable to me now because of this drop? That question alone will shift your financial trajectory. And don't forget the Aussie advantage. You live in a country with a stable government, strong financial institutions, and access to investment platforms that are among the best in the world. Use them. If you're not investing, you're not just standing still. You're going backward. 2. Recap this section. Use ASX ETFs to stay grounded in the local market. Add international ETFs to benefit from AUD weakness. Take control of your super and adjust allocations strategically. Contribute more, even in small amounts. To harness compounding, think long-term, stay calm, invest consistently. Let's face it, depending solely on your job or superannuation is a risky game in today's economy. With the Australian dollar fluctuating, property prices soaring, and interest rates rising, more and more Australians are looking for something more solid, income that doesn't stop when the market shakes. That's where passive income comes in. And no, it's not just a buzzword, it's a mindset and a set of tools that can take you from paycheck to freedom. In this part of the video, I'll walk you through 3 of the most effective passive income strategies in Australia today, and how they're working right now in real people's lives. Let's begin with the classic, rental property income. In a country like Australia, where home ownership is not just a goal but a national identity, property investment remains one of the strongest tools for wealth creation. But it's not what it used to be. Gone are the days of buying any house and watching it double in 10 years. Today, smart investors are looking at high-yield regional areas, dual occupancy builds, and rent vesting, where you rent where you live, and invest where it's cheaper. Take Nguyen, a 36-year-old nurse from Melbourne. He wanted to buy a home in his city but was priced out, so instead, he bought a duplex in Ballarat. One side he rents out to long-term tenants. The other is an Airbnb style, short stay. Combined, it generates $4,200 a month in gross income. After expenses, Nguyen clears around $1,700 monthly in profit. A stream of passive income that goes directly into paying off the mortgage and topping up his super. The kicker? Because the AUD is weaker, many international tourists are returning to regional Australia, boosting short-stay demand in places like Ballarat, Bendigo, and the Central Coast. Not into property? That's okay, because dividend-paying stocks can be just as powerful and way more accessible. Australian companies are famous for offering high dividend yields compared to their US and European counterparts. Think of names like Commonwealth Bank, CBA, Telstra, TLS, and Wesfarmers, WES. Some of these companies pay out dividends of 4 to 6% annually, and that's before potential capital gains. Emma, the barista we mentioned earlier, now invests $150 a fortnight into a dividend ETF called IHD, which focuses on high-yield Aussie stocks. Every quarter, she gets a small but growing payout, reinvested back into her portfolio. It's not much now, she says, but in 10 years, this could be paying part of my rent. That's the power of reinvested dividends. Over time, they grow into a snowball of income, and during times when the dollar is weak, Aussie dividends remain in AUD. You're not losing out on currency exchange or global shocks. Now let's talk about something more modern and exploding in popularity: digital side hustles that create automated income. No, I'm not talking about crypto scams or shady drop shipping courses. I'm talking about legit businesses that run even while you sleep, from online courses and print-on-demand merch to affiliate marketing and YouTube channels. The cost of starting has never been lower. Platforms like Etsy, Amazon KDP, Canva, and Shopify have made it easier than ever to launch a micro-business from your living room. Let me introduce you to Sophie, 40, from Adelaide. During lockdown, she created a simple ebook on mindfulness, uploaded it to Amazon, and forgot about it. 1 year later, it had sold over 1,500 copies, earning her $5,800 in royalties, all in USD. With the Australian dollar down, her USD earnings converted to more AUD than ever before. Today, she runs a small digital publishing side hustle that brings in around $600 a month. Not enough to quit her job, but more than enough to cover groceries, utility bills, or a getaway to Noosa. So here's the point. Passive income is not a fantasy. It's a system. And in Australia, that system is more accessible than ever. Whether it's through real estate, the stock market, or digital products, you have options. And the best part? You don't need to choose just one. Let's break it down with a simple game plan. Challenge number 2. This week, pick one passive income avenue and take a small action. If it's real estate, research 3 high-yield regional areas on realestate.com.au. If it's dividends, set up a micro-investment app like Spaceship or Rise and buy your first $50 worth. If it's digital, create a Canva account and draft a design or outline for a digital product you could sell. It's not about becoming rich overnight, it's about planting multiple seeds that will grow over time, no matter what the dollar does. And speaking of seeds, the smartest investors aren't just focused on the next 12 months. They're thinking decades ahead, which is exactly what we'll cover in the next part. Long-term wealth planning, retirement, and how to prepare for a future where your money works harder than you ever could. Building wealth isn't just about investing smartly today, it's about making sure that wealth lasts through job changes, housing market bubbles, economic slowdowns, and yes, even a falling dollar. That's why long-term planning is the real secret of Australia's wealthiest individuals. They think beyond their current income. They plan for retirement, protect their assets, and structure their financial life like a fortress. And that's what we're going to explore in this part of the video. How to create a plan so strong, not even a collapsing dollar or rising interest rates can shake it. Let's begin with the backbone of Aussie retirement planning, superannuation. It's often overlooked or left on autopilot, but make no mistake, your super is a multi-$100,000 asset in the making. Yet too many Aussies don't optimize it. They stick to default plans, forget about fees, or ignore allocation. Here's the truth. If you're under 45 and not actively managing your super, you're potentially leaving hundreds of thousands of dollars on the table. That's not fear-mongering, that's maths. Here's how to take control. Step 1. Check your current super provider and their investment allocation. Are you overly concentrated in Australian equities? If so, you may be exposed to currency risk if the AUD loses buying power internationally. Consider moving a portion to global equities, and even better, to currency-hedged options. Step 2. Examine your fees. Low-cost index fund options, like Host Plus Indexed Balanced or Australian Supers Indexed Diversified, can outperform high-fee active funds over 20 to 30 years. And finally, Step 3. Voluntary contributions. Salary sacrificing just $100 a fortnight into your super, especially if you're under 40, could mean the difference between a retirement with freedom or one dependent on the age pension. Let's look at a case study. James, 42, from Newcastle, used to work FIFO in mining. He had 3 different super accounts from past employers, none of them optimized. In 2021, he consolidated them, switched to a low-fee, high-performing fund, and started contributing an extra $250 per month. Fast forward to 2025, and his super balance has grown by over $46,000 more than it would have if left untouched. And that's during a period where the AUD declined by over 10%. I used to think retirement was just something that happened later, James says, but now I see it's something you build. Now let's talk about estate planning and wealth protection. The topics no one wants to think about until it's too late. If you own property, run a business, or have significant assets, you need a will. But even more than that, you need to consider asset structures like family trusts or SMSFs, self-managed super funds. These aren't just for the ultra-wealthy. They offer real benefits in tax planning, protection from lawsuits or creditors, and multi-generational wealth transfer. For example, using an SMSF, you can buy property through your super, generate rental income inside the fund, and benefit from concessional tax rates, all while keeping the asset protected and growing. And here's a cultural note that matters. Australian pride is rooted in independence. We don't want to rely on others, including the government. But failing to plan is planning to be dependent. That's why true financial independence is about more than hitting a number in your bank account. It's about having systems that work even when you're not. Your investments should pay you. Your super should grow without your constant attention. Your estate should protect your loved ones. It's not about control. It's about freedom. To get there, let's shift the mindset. Don't ask, what can I buy with this money? Ask, how can this money work for me for the next 30 years? Don't ask, can I afford this? Ask, will this decision help or hurt my future financial self? So here's your next practical step. Challenge. Number 3, create your long-term wealth action plan. Log in to your super account and document your current balance, your investment allocation, your contribution rate. Schedule a meeting with a financial advisor or super fund representative to review your future projections. Write or update your will. If you don't have one, use a service like State Trustees, or start with a simple online template to get going. Research SMSFs or family trusts, not necessarily to use now, but to understand how they might help you in 5 or 10 years. By the way, if you're watching this in your 20s or 30s, you're in the best position of all. Because the earlier you start thinking like this, the easier everything else becomes. If you're in your 40s or 50s, there's still time. But it requires intentionality and focus. Remember, real wealth isn't loud. It's not the car, the house, or the Bali trip. It's the quiet confidence of knowing that your money is protected, growing, and serving your life's bigger purpose. And in the final part of this video, we'll wrap up with a powerful summary and a challenge that could completely shift your financial reality in just 7 days. Let's take a moment to breathe. You've just taken in a wealth of insight, not just theories, but real strategies for building and protecting your financial future in a world that's changing fast. If your head is spinning a little, that's okay. Because the real magic isn't in remembering every detail, it's in doing something right now. Let's recap what we've uncovered. We began by asking a tough question. Why is the Australian dollar losing value? Even when interest rates are rising? And we answered it. The forces driving currency value are more than just central bank decisions. They're about investor confidence, global volatility, debt levels, and economic narratives. While the Reserve Bank of Australia lifts rates, many Australians are still watching their cost of living rise and their purchasing power fall. From there, we confronted the problem head-on. Aussie wages are flatlining. Property prices are still sky-high. Superannuation is misunderstood or ignored. And the average Australian is being squeezed by inflation, falling AUD, and financial confusion. But instead of staying stuck in that problem, we moved forward. We explored real tactical strategies. You learned how to use ASX and international ETFs to protect and grow your money, even when the Aussie dollar is weak. You discovered how to unlock the power of your superannuation, from contributions to allocation to fees. You saw how to create passive income through real estate, dividends, and digital side hustles that grow without burning out. And you got a long-term wealth plan, one that includes retirement strategy, estate protection, and asset structuring for the decades ahead. You met Liam, Nguyen, Sophie, Emma, and James, ordinary Australians using these tools to build extraordinary results. And maybe, just maybe, you saw yourself in one of them. But here's the truth. Nothing changes until you do something. So here's your final challenge. And it's a big one. The 7-day financial reset. In the next 7 days, I want you to complete 5 actions. Just 5. Not to overwhelm you, but to ignite your momentum. Check your super, log in, review your balance, asset allocation, and fees. Make one change, even if small. Buy your first investment, $50 into an ETF, local or global. Doesn't matter. Start. Track your spending. Use an app like Pocketbook, or just write down your spending for 1 week. Awareness is power. Research 1. Passive income idea. Whether it's renting out a room, creating a digital product, or exploring dividend stocks, take the first step. Talk about money with someone you trust, a partner, a friend, a parent. Break the silence. Create accountability. That's it. 5 actions, 7 days. A completely different trajectory. Because here's the bigger truth. Australia is changing. The economy is changing. Retirement isn't what it used to be. Wealth isn't guaranteed. And the dollar? It may never go back to what it was. But that doesn't have to scare you. It can empower you if you choose to act. So the next time you hear someone say, the dollar's crashing or the economy's stuffed, you'll smile. Because you'll know you've got a plan, you've got assets, you've got vision, and more than that, you've got the guts to do what most people won't. Take control of your financial future, no matter what the markets are doing. Thanks for watching. If this video sparked something in you, share it with someone who needs it. Leave a comment with what step you're committing to this week. And remember, wealth doesn't come from luck. It comes from learning, applying, and staying in the game. This is your moment, mate. Make it count.